So, you want to live off your investments. It's the ultimate dream, right? Total financial independence. But let's skip the fluff today. In this explainer, we're getting straight into the hard math of what it actually takes to never work for money again.
Because that's the real question, isn't it? Exactly how much do you need? You see wild numbers thrown around all the time, but we're going to use a brilliant, grounded shortcut that will literally change how you look at your everyday spending.
Here's our roadmap. 1. The powerful rule of 300. 2. The true cost of expenses. 3. Sequence risk. 4. The impact of Italian taxes. 5. The pension advantage. And 6. The practical alternative, cost fire.
Section 1. The powerful rule of 300.
Okay, if you remember just one thing today, make it this. You're probably familiar with the classic American 4% rule, right? Multiply your annual expenses by 25. But come on, nobody really tracks their life annually. We naturally think in monthly budgets. So let's flip it to a bottom-up approach. Mathematically, it's the exact same thing, since 25 times 12 is 300, but it's way more intuitive. You just take your monthly spend and multiply it by 300.
Section 2. The true cost of expenses.
Let's put some real numbers to this. Based on the source data, a typical family in northern Italy spends about 3,200 euros a month. Applying our rule, 3,200 times 300 gives us 960,000 euros. That is your baseline portfolio to sustain that exact lifestyle forever. But to really grasp this, we need to look a little closer at the everyday stuff. This is where the rule of 300 becomes a total game changer. It transforms every single fixed monthly cost into a massive capital goal. Think about a 100 euro monthly streaming or internet bill. You literally need 30,000 euros sitting in a portfolio just to fund that forever. Spending 150 euros a month on clothes? That requires 45,000 euros of capital. A 200 euro gym membership demands a staggering 60,000 euro commitment. It completely shifts your perspective, right? Every 100 euros of your monthly lifestyle requires 30,000 euros of invested capital.
Section 3. The sequence risk.
But obviously, the market isn't a straight line up. Let's look at Chiara and Enrico. Both saved €1 million. Both have the exact same portfolio, 60% stocks, 30% bonds, 10% gold. Both averaged a 6% return over 30 years and withdrew the exact same amount. But 30 years later, Chiara sitting on 2.5 million euros, while Enrico went totally bankrupt by year 21. How? Timing. Chiara saw great returns early on, so her portfolio outpaced her withdrawals. Enrico got hit with a 40% market crash right out of the gates. By continuously withdrawing during that crash, he permanently crippled his capital. And this is wild. When you're actually in the withdrawal phase, your asset allocation only determines about a third of your success. A massive 67% of your outcome comes down to the sequence of returns, which is basically just luck. You absolutely need flexibility to survive those early market dips. You can't just cross your fingers and rely on average returns.
Section 4. The impact of Italian taxes. Now, let's bring these American FIRE concepts into European reality, specifically Italy. Because, well, the government always takes its cut. We don't have tax-free withdrawal accounts like Roth IRAs here, so you pay capital gains taxes to live. But here's the silver lining. You only pay taxes on your profit, not your principal. So if your portfolio has grown over the years and is now 60% profit and 40% original money, you're only taxed on that 60% portion.
When you blend the 26% tax on stocks and the 12.5% on government bonds and apply it just to those profits, your effective tax drag is usually around 13%. To cover that gap, Italian investors actually need to adjust the math. The rule of 300 effectively becomes the rule of 345. It's a hurdle, for sure, but totally manageable when you plan for it.
Section 5. The pension advantage.
But, hey, it's not all bad news. Italians actually have a massive structural advantage that offsets those taxes. Unlike American calculations that assume you're completely flying solo, almost everyone here gets some kind of INPS public pension eventually, and the math on this is awesome. Every 100 euros per month of future state pension you expect reduces your FIRE target by exactly 30,000 euros.
This sets up a really smart two-phase strategy. Phase 1, the pre-pension phase, where you retire early and rely 100% on your portfolio. Then Phase 2, the post-pension phase, where the state kicks in, letting you drastically reduce your withdrawals. Because of this, the closer you are to state retirement age, the lower your required FIRE number actually is.
Section 6. The practical alternative. Cost fire.
Look, seeing that massive final target number can still be pretty intimidating. That's where cost fire comes in. It's a fantastic alternative milestone. Basically, cost fire is when you reach a portfolio size today that is big enough to hit your final retirement goal just through compound interest, meaning you never have to invest another cent of your own money again.
Let's put that into perspective. Say you want 1 million euros in 20 years. Assuming a conservative 4% real annual growth, you only need 452,000 euros invested today. That's less than half. You just let the market do all the heavy lifting for the next 2 decades.
Hitting cost fire is an absolute game changer for your lifestyle. You can stop obsessively saving, you can downgrade to a less stressful job, switch to part-time, move somewhere cheaper, or just spend your entire paycheck to upgrade your daily life right now. It proves that financial freedom isn't just a finish line you cross at the very end. It's a spectrum.
Now, figuring out your specific sequence risk, the tax drag, and your exact cost fire number involves a lot of moving parts. The source material actually points to a free downloadable dashboard that calculates all this for you, complete with a 1,000 scenario Monte Carlo simulation to stress test your plan. I'd highly recommend running your own numbers, because seeing your own data laid out makes it all very real.
So, we've broken down the rule of 300, the impact of taxes, pensions, and tweaking your monthly budget. But at the end of the day, you have to ask yourself, what is the price of your freedom to choose? This isn't just about hoarding cash, it's about buying back your time and your autonomy. So do the math, find out what every 100 euros truly costs you, and ask yourself, what are you willing to trade for your freedom?